Welcome to the 3-Edge Weekend Review for the week of September 2nd. I'm Fritz, Folts, the Chief Investment Strategist here at 3-Edge, and joining me here once again today is Steve Cucchiaro, CEO and the Chief Investment Officer here at 3-Edge Asset Management. Today, with summer officially in the rearview mirror and the stock market facing the often historically challenging month of September, Steve and I will discuss whether, as the Fed prepares to begin to lower short-term interest rates at the next FOMC meeting, will there be a soft landing for the U.S. economy, whereby the Fed can tame inflation without pushing the U.S. economy into recession? Or has the Fed kept interest rates too high for too long, causing a more severe economic slowdown and even a recession in the months ahead? Quick recap of this past week, which was shortened by the Labor Day holiday on Monday, but it wasn't pretty for U.S. equities. In just the 4 days, the S&P 500 index suffered its worst weekly decline since March 2023, including a rather steep one-day sell-off on Tuesday. Investors seem to have become more concerned that perhaps the U.S. economy may be softening more dramatically than previously anticipated. On Friday, the Bureau of Labor Statistics released the jobs report for August, which showed that hiring in the U.S. fell short of forecast and that the 3-month payroll growth actually slowed to the lowest level since mid-2020. The much-anticipated jobs report will keep alive the debate as to whether the Fed will cut short-term rates by 25 or perhaps 50 basis points later this month. The same report also showed that the unemployment rate actually edged down to 4.2%, and this was the first time that had happened in 5 months, but the decline reflected a reversal in layoffs of temporary workers. So a bit of an anomaly there. So Steve, need your help here. As the Fed prepares to begin to cut short-term interest rates, it seems that, the talk on Wall Street may be a little less positive about whether Jay Powell can pull off this soft landing or not. But to get us started, maybe just to level set, can you just explain what it is that people mean by a soft landing when this discussion arises?
Well, it is true that all year long, investors and Wall Street analysts have been talking about soft landing and anticipating soft landing. And as you mentioned, a soft landing is when the economy slows down enough to bring inflation back to target, which is 2% right now, but continues to grow quickly enough to keep unemployment stable and to avoid a recession. It's what they call Goldilocks, not too hot, not too cold, but just right. So I took a look at every Fed rate cutting cycle over the last 75 years very carefully. And there were 17 rate cut cycles in the last 75 years. And of the 17, there was only one that produced a soft landing. That was in 1995. There were 3 one-quarter point cuts. Real growth did drop below 2%, but stayed above 1%. And also importantly, it was a time when the yield curve never inverted. And we know that all the other times that did coincide with recessions, we had almost in every case yield curves that were inverted, like we do today. So the other thing I know is that almost before every time the Fed were to cut rates, the expectation, back in history during all those times was that there would be a soft landing. People didn't expect a recession, so the recession was always a surprise. And you also heard media say, well, yield curves no longer work. And then, of course, they did, because then the recession came.
All right, so let's suppose then that through this monetary policy tightening that has been in place for a long period of time here, what if we get a hard landing? So what if they can't, stick the landing, as they say, and get a soft landing? What will that mean for the markets? I guess both the stock and the bond market, if that were to occur.
So the market has done so well over the last 12 months, in expecting a soft landing, being all excited about rate cuts, that a hard landing would certainly be a shock to the market. And that could be a catalyst for a very meaningful correction. Now, here's one interesting data point. Over the last 12 months ending in August, the end of August, earnings per share of the S&P 500 index were up 6.2%. And we know over the long term, the price per share, or the price that people pay to buy stocks, and in this case, the S&P 500 index, always goes up at the same rate as earnings per share over the long term. But over the last 12 months, while earnings went up 6.2%, the price per share of the S&P 500 went up 25.3%, 4 times as much. So you could say, well, investor psychology has just been so bullish, not only about the excitement around AI, artificial intelligence, but also it's been like a tease, the prospect that, well, pretty soon the Fed is going to cut rates. And so even when they cut them, even if we have a soft landing, it could be that that's already more than priced into the market. So that's something that I would be careful of. Also, sometimes people ask me, well, why is it that in all these rate cutting cycles, they're almost always too late? And one way to think about that is that the Fed is data driven. The data that they look at is typically lagging indicators like unemployment rate, which is a lagging indicator, inflation, which is a lagging indicator. The data that reflects the past can often be revised. And then by the time they do take action, it takes several months because monetary policy always operates with a lag for that to have an impact. So that's why the Fed is almost always late in cutting.
All right. Final question, which is what I typically ask you, and that is that, so now the Fed is poised to begin to cut rates where it seems like maybe the market is less sure about the soft landing now. So what might investors just consider doing in terms of their portfolios heading into this FOMC meeting, going forward from here?
Well, if you remember a video we did earlier this year, we had a phrase that seems quite appropriate now, perhaps, and that is, be careful what you wish for. There's so much excitement in a positive way about the prospect of rate cuts, and yet here we are just days away from the first rate cuts we've had in a long time, and it might not necessarily mean something great. Now, let's say the soft landing is achieved, and it's this will be the 18th rate cutting cycle in the last 75 years. And let's say it's the second time we get a soft landing. So we might get further gains in the market in the short term. But we also, as I mentioned, might realize that all the gains are already priced in. It was already anticipated. And so if we do get any gains, it could be certainly given back in the next correction. And even with the big rally we've had up until this week, we still didn't get back to the highs in mid-July. So we might look back and say that was the peak of the market, and the correction or a bear market rally might have started in mid-July. Now, also because as we measure it, the market after all these rallies are now quite very overvalued compared to the fundamentals. We do think that even if the market continues higher, the upside is limited and the downside does show significant risk. So in summary, we would say at best a moderate allocation to equities for now, with an eye to becoming more defensive should this soft landing phase not look so promising, and should the market turn from positive momentum to negative momentum. We favor hedges in gold, tips, and shorter-term treasuries. I observed that there's this big positive market sentiment toward long-term treasuries because typically when you get a recession, everyone piles in long-term treasuries. But I would caution that that was during a deflationary period over the last 40 years up until 2020. And right now, the spread between long-term bond yields, for instance, the 10-year treasury bond yield, and inflation is less than 1%. So we think there's limited upside with long-term bonds, and they're not the best hedge.
All right, excellent. Well, Steve, thank you. So now, along with everyone else, we'll wait to see what the Fed will do at the FOMC meeting in mid-September, and we'll see what the market reaction may be. So thanks for that. Next week's video, Eric Beagleisen, our head of investment research, and I will provide our monthly view from the edge, where we provide our most recent outlook for the global capital markets based on our proprietary 3-Edge capital markets model. As a reminder, all our videos are always available on our 3-Edge YouTube channel, and if you know someone who you think might enjoy and benefit from our weekly videos, please feel free to share them. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.